Hello everyone. In week 7 of the module, we will cover financial analysis techniques. The tools and techniques of financial analysis are useful for analyzing the performance of a company as well as the trends in performance over time. Specifically, we will cover graphic analysis, regression analysis, common size analysis, and financial ratio analysis as different tools or techniques of financial analysis. Graphics or charts are useful in communicating and providing comparisons of performance. This pie chart here is created using Excel and it shows the geographic composition of the 2011 operating profit margin for Colgate-Palmolive's oral, personal and home care segment. It shows the analyst to communicate about the geographic composition of the segment's operating profit. Most of the operating profit margin for Colgate-Palmolive's oral, personal and home care segment is coming from Latin America. Now this bar chart is again created using Excel and it shows the geographic composition of the operating profit margin for Colgate-Palmolive's oral, personal and home care segment from the year 2007 to 2011. It shows an analyst to communicate about the geographical composition of the segment's operating profit over time, that is from 2007 to 2011. Most of the operating profit margin for Colgate-Palmolive's oral, personal and home care segment has come from Latin America in each of the past 5 years. The biggest change in operating profit margin has been also noted for Latin America, that is from around 1 billion in 2007 to more than 1.4 billion in 2011. It is also noted from this bar chart that Europe and South Pacific has shown a decline in profitability from 2007 to 2011, though the decline is relatively small. In percentage terms, Greater Asia and Africa shows the highest increase comparing 2007 and 2011 profitability. Relatively, the profitability in dollars have nearly doubled in the 5 years time. This is a bar chart of the operating profit margin on quarterly frequency from 2006 to 2014 for Colgate-Palmolive's, and the operating profit margin, as we know, is calculated as operating profit divided by sales, and this facilitates comparison of the operating profit or trend in profitability over time. Note that there is a significant dip in operating profit margin in the first quarter of the year 2010. This is explained by the one-time charge related to the transition to hyperinflationary accounting in Venezuela. Overall, the operating profit margin shows a steady increase when compared to 2006 and remains relatively stable across time. Regression analysis can be used to analyze the trends in specific line items or ratio in complex situations. For example, analysts can use regression analysis to identify the relationship between the sales of the firm and the GDP and then use it to forecast the company's sales for future years. Here we have a scatter plot with a trend line that is created using Excel. It shows the relationship between sales growth, that is variable Y, and GDP growth, that is variable X. Analysts might use regression analysis, combining it with a forecast for the GDP growth rate as one input to forecast sales growth and earnings. For example, if the forecasted GDP growth rate is 3%, using this model here, we can forecast the growth rate in sale as 0.1176 into 3 plus 5.8177. If we multiply this into this and then add it with that, we get 6.1705 as the forecasted sales growth rate for the next year. The next financial analysis technique that we use is the common size analysis. In common size analysis, we express financial data, including entire financial statements, in relation to a single financial statement item such as the total assets or revenue as the base number. There are two types of common size analysis. vertical common size analysis and horizontal common size analysis. In the vertical common size analysis, in a given year, every item in the income statement or a balance sheet or a cash flow is divided by the relevant one number. For example, for the balance sheet, each item is divided by the total assets. For the income statement, each item is divided by total net revenue or sales. And for the cash flow, it may be represented as a percentage of sales or total assets or total cash inflows or total cash outflows. Vertical common size analysis helps highlight the composition and identify the elements or items that are the most important in the income statement, balance sheet or cash flows. Horizontal common size analysis is used to analyze the same item in relation to its prior periods. So if we want to see the trend of growth in a particular line item in the balance sheet or cash flows or income statement, we divide each year its value by the base period value. So the value for the year 2011 is divided by the value of 2010. Similarly, the value of 2012, 2013 and 2014 are also divided by the base year number of the same item, that is the value in 2010. Horizontal common size analysis therefore provide the percentage increase or decrease of each item from the prior year, or in case we have a base year taken, so then in terms of the base year if we are doing a long-term trend analysis. It highlights the items that have changed unexpectedly or have unexpectedly remained unchanged. Therefore, the analyst can identify the underlying reasons that have led to the unexpected change or the unexpected dullness of the figure. Here we have a partial common size balance sheet for period 1 and period 2, and this represents cash, receivables, inventory and fixed assets net of depreciation. Each item here is represented as a percentage of cash. So we see that in period 1 cash is 25% of assets, while in period 2 it is 15% of total assets. Similarly, receivables are 35% of total assets in period 1, but they are 57% in period 2. Inventory on the other hand is higher in period 1 as a percentage of total assets, but it has declined to 20% in period 2 of total assets. We have to use judgment and interpretation to answer questions such as what are the important components of the company's balance sheet, have any notable changes occurred, what caused the changes. For example, in period 2, receivables are 57% of total assets. What are the possible reasons for the increase in receivables? For example, the company may be making more of its sales on a credit basis rather than a cash basis. It may be due to the actions taken by a competitor of the company. Alternatively, it may be the case that the increase in receivable as a percentage of asset is merely due to a change in another asset category. For example, here we see the decrease in inventory. The analyst would then be required to investigate why that asset category had changed. There may be another reason for the increase in receivable as a percentage of total asset. It may be that the company has lowered its credit standards, relaxing its collection procedures, or adopting more aggressive revenue recognition policies. The analyst can then turn to other comparisons and ratios, comparing the rate of growth in accounts receivable with the rate of growth in sales, for example, to help determine which explanation is most likely. On this slide here, we have the common size vertical analysis provided for company 1 and company 2. Every item in the balance sheet is presented as a percentage of total assets, and we see company 1 has more cash as a percentage of total assets relative to company 2, and similarly company 2 has more receivables relative to company 1. Company 2 also has relatively lower inventory as a percentage of total assets, but has more fixed assets and more investments as a percentage of total assets relative to company 1. As we are comparing two companies, we are concerned with questions such as what are the important components of each company's balance sheet, what are the notable differences between the two, and what explains their differences. Company 1 is clearly more liquid, as liquidity is a function of how quickly assets can be converted into cash. We see that it has 38% of its assets in cash, which is relatively higher to the 12% for company 2. As cash earns low yields, it is particularly important to note why would company 1 hold to such large percentage of total assets in cash, given that it is not a very efficient use of surplus cash. It may be that company 1 is contemplating to acquire another company or is holding a large amount of cash so that it can protect itself in particularly volatile operating situations such as the COVID-19 we have right now. Another issue that is highlighted by the comparison in this case is the relatively high percentage of receivables in company 2's assets. This may be indicating a greater proportion of credit sales, overall changes in asset composition, or lower credit or collection standard, or aggressive accounting policies such as revenue recognition. Here we have an example of how to use comparative growth information. In July 1996, Sunbeam Incorporated, which is a US company, brought in new management to turn the company around. In 1997, the company reported the following increases in revenue, receivables, and inventory. Clearly, the growth rate in receivables and inventory has outgrown the growth rate in revenues. This is something alarming. Ideally, receivables and inventory should grow at a rate slower than or similar to the growth rate in revenue. When receivables grow at much faster rate than revenue, it may indicate operational issues such as lower credit standards or aggressive accounting policies for revenue recognition. On the other hand, inventory growing faster than revenue may indicate an operational problem with obsolete inventory or aggressive accounting policies such as an improper overstatement of inventory to increase profits. Alternatively, innocuous explanation could have been that the company was building inventory in anticipation of demand. At Sunbeam, it was basically aggressive accounting policies. Sunbeam was later charged by the US Securities and Exchange Commission with improperly accelerating the recognition of revenue and engaging in other practices such as billing customers for inventory prior to shipment.